And- Okay, so hello, welcome. Tonight we're going to break down some of those big changes to federal financial aid and student loans and more changes than we've seen in the past decade. So these will impact how much aid your student is going to be eligible for, how much you can borrow as a parent, and then how the debt is going to get repaid for in the future. So we're going to walk through what you need to know so that you can plan wisely. These changes that we're going to talk about go into effect July of 2026 and will apply to your students' borrowing and to your borrowing as parents after that date. So July 1, 2026 is the date that we're looking at. We're going to talk about some FAFSA formula changes, Pell Grant. We thought there was a change, but there actually isn't there. So I think I hid that slide. There are changes to the ParentPLUS loans and repayment options and student loans and subsidized interest. Some families will be grandfathered in under the old rules, but only for a limited amount of time. So we'll go over that as well. If you haven't met me or we haven't crossed paths, my name's Corey Murphy. These are my two. I have been at this for 23 years now. My proudest moments are when we finish with a class, the class of 2025, just this last year. We worked with 158 seniors. They collectively earned $7.9 million in scholarships. That's free money. We're not counting loans and work study. It's the free stuff that they didn't have to pay back. They got admitted 676 different colleges. Excuse me, they were admitted to 676 colleges, and that spread out over 335 different colleges nationwide. So it's not just about colleges in the East or the South or the West. This is applicable everywhere, and they achieved an 82% acceptance rate. So I get very excited when I get to personally advocate and work with families to help you make the best decisions for yourself and for your kiddos. Okay, so let's dive in. Along the way, if you have questions, you're welcome to put them in the chat. I'm gonna steer clear of that until the end, and we'll have plenty of time for questions at the end as well. So, first things first, let's talk about FAFSA and asset exemptions that got reinstated. So, years ago, if we had businesses and we owned more than 50% of the business and we had fewer than 100 employees, we didn't have to report that business on the FAFSA. That changed in 2024, and now with the passage of the big, beautiful bill, we're back to not having to report our businesses. So that's great news for all of you business owners. If you have property that's wrapped in an LLC, that's a business. Those assets now are excluded off of the FAFSA form. If we're at schools that want the CSS profile form, the business information will still go on the CSS. So everything, I'll try to say this is FAFSA, this is CSS. So business exemption excluded, FAFSA only. This is if you have a fishery, if you have a farm, any of those things. So not having to report the value of our businesses means that our student aid index potentially is going to be lower, which means that our financial aid potentially is going to be higher. Okay. So I edited this slide and left it in. There was talk that the Pell Grant program is heavily underfunded, and that is true. But after the passage of the bill, Congress met and they allocated enough money to fund Pell Grants. So we thought it was going to get cut down to 5,700. It's not. That max Pell Grant is going to stay up at the 73.95 number. Now, to get a Pell Grant, when you calculate your student aid index, it's maximum Pell Grant minus your student aid index, and that's your Pell Grant amount. Now, the minimum Pell Grant that you can get is $500. So we have to have at least 500 there. And then it's going to be proportionate up to that 73.95. The thing that is changed and new is part-time students used to be able to get the Pell Grant. That is not the case. The students need to be enrolled for 15 credits per semester. Or their Pell Grant could be reduced, or it might just automatically be 0. I haven't seen guidance on that specifically, but definitely we're going to have to be enrolled full-time, either in a degree-seeking program, a trade program, something that is the equivalent of full-time enrollment to get the full Pell Grant. So that means students might have to take a heavier course load to maximize that financial aid. Okay. Subsidized loans for students are safe. There was talk that the subsidized student loan was going to go away. That was saved. So our students do have access to subsidized student loans throughout the 4 years of their undergraduate education. So, and that can be a great tool for accountability, really. You can have your student take a student loan and say, hey, buddy, you go do your job and you get A's and B's and you graduate on time and we'll pay the student loan off. If not, it's on you, right? That's one of the ways you can build accountability in when you use the student loan. So I'm very glad that the subsidized portion of that was saved. Okay. Parent loans, there's a lot of changes here. So starting in 2026, the big change is parents, we are now capped at 20 per year per dependent student. Okay. And we're capped at a maximum of 65,000 per dependent student. So you can do the math. 20 times 3 years of school, we're at 60. So no longer as a parent can we max out all 4 years of school. This is a planning issue. This is do we need to use loans? How much? These caps are on the federal loans. So do we use private loans instead of? Do we use private loans first and then the federal loans last? There's a lot of variables in there, but those are the questions to ask and the decisions to make for your family. The other thing is ParentPLUS loans used to be eligible for income-based repayment. That door has closed. ParentPLUS loans used to be able to be eligible for public service loan forgiveness. That door has closed. Only the students are going to be eligible for income-based repayment or public service loan forgiveness. As parents, depending on the size of the total loan balance, we will have a standard repayment schedule that will be on a 10-year note or a 25-year note. And this is for new borrowers beginning in 2026. So if you have a senior in high school now, this absolutely applies to you. They're a 2026 grad. They're going to go to college in the fall of 2026. This all applies to you. If you have a student who just graduated in June in 2025 and they're going to college right now in 2025, you're not subject to this. There's a legacy provision. And what that means is if you use the ParentPLUS loan now for this academic year 25-26, you are grandfathered in to the unlimited plus loan for their 4 years of college. Okay, so We might want to talk about that as well. You may not need or want to do a plus loan this year, but maybe you might need or want to do one later. Later, you're going to be subject to the caps because you'll be considered a new borrower. You have to do it now, even a little bit, to keep that window open so that we have the unlimited access to the unlimited. So if none of that makes sense, here's the visual, because I'm visual as well. If you have a student who's going to school right here this year, 2025, you're considered an existing borrower. If you take a little or a lot of a plus loan, you will have unlimited through the 4 years of high school, through 2029. Okay. If you have a high school graduate, a 2026 grad, and you start with the plus loan here, you're considered a new borrower and we're subject to the caps and the maximum. Okay. All right. Good. Questions in the chat. Hit 'em, let them fly. For students, there are now federal lifetime loan limits. So as an undergrad, your student can get 5,500, 6,500, 7,500, 7,500 for their undergrad. That's 27,000. Then as the student, they can get additional loans for grad school, for law school, for medical school. Those are there. They do those in their name. However, they cannot go over $257,000 in total. Now, if you went to law school or med school, or you have an older student in law school or med school, 250,000 may not be enough to cover all of that. So then, again, do we go a private route? Are these med schools going to have to come with their own money? Time will tell. But be aware that our students have a lifetime cap of 257,000. Our parent loans, whatever we have in our parent loan, is not included in that maximum lifetime limit for them. So this, again, grad school, law school, med school could be an issue. So really forecasting out all the years of their education has always been important, but even more important now. Okay. All right, repayment plans. Lots of changes for repayment plans. Again, this is for new loans that are taken after July 1st, 2026. Okay. There is a standard repayment plan, and depending on the size of the loan, it will be 10 years or 25 years. As parents, this is the only one that we have access to. Students have standard repayment, or there will be this new repayment assistance program called a RAP program. In the RAP program, when they finish their education, they consolidate all of their loans, they wrap them into one, and then their repayment is going to be 1 to 10% of their income for 30 years. Okay. And all along the way, when they make their payment, it's going to count as a payment and any interest will be wiped away. Year 1, year 2, they're making their payments, any interest is going to be wiped away. So that's a nice change, because in the previous income-based repayment plans, the interest was added back and then it was capitalized. And that's part of how you see in the news that these poor kids can't get out from under their loans. So students can do standard or they can do RAP. Parent loans, we only have standard. Okay. Public service loan forgiveness. If you don't know what that is, it is a great program and it still exists for students. What public service loan forgiveness is they finish their degree and they go to work for a qualifying nonprofit 501c3 company. They work for that company for 10 years. Okay. They make income-based repayment, which is 10% of their income, their discretionary income, for 10 years. So they make 120 qualifying payments. At the end of that 10-year period, whatever balance is left on their student loans is forgiven tax-free. So if you do have students who are going to grad school, law school, med school, and the accumulation of those loans is alarming, then this might be a strategy you start talking about with them now. I did this with my own daughter when she was in high school. Med school was on the horizon, and I said, okay, you can go spend a gazillion dollars on med school. Go right ahead. But when you're done, you are going to work in public service for 10 years. You're going to make your student loan payments for 10 years. You're going to pay off a small portion of those loans, and then the rest is going to be forgiven. At that point, then you can go do whatever you want and make a gazillion dollars. Otherwise, they're going to pay all of that back on the standard repayment schedule. So that's a great option for students. It is not an option for us as parents any longer. Okay. So those are the facts, and I'm happy to answer questions about those in the chat or at the end. But I like to tell stories, so I have 3 real scenarios. Maybe you see yourself in those scenarios. Maybe you see, maybe not, but this is how we really learn and incorporate this material. So let's talk about a student who is a freshman who graduated high school in 2025 and who's starting school in a few weeks. The parents took the ParentPLUS loan. PPL is ParentPLUS loan. The legacy provision provides for them and makes them eligible to have unlimited borrowing based on the old rules through 28-29. So that is all 4 years of the undergrad. This student must graduate on time, because if they take extra time in that 5th year, the family is going to have zero access to federal loans. And that we don't know. Either they're going to be capped at 20 or they're going to have zero access. We're waiting on that guidance, and it will come. The risk here is if that student goes 5 years and that family needs another loan and they have to go apply for a private loan, they are going to show the federal parent loans on their debt to income. And now the private loan lender is going to look at debt to income and credit score, and they might not get the best rate. They're definitely not going to get the best rate that they could if they get approved at all. So now is the time to really start talking to your students about the importance of graduating on time. That may mean summer school. That may mean, some taking extra credits, but 4 years, they need to be done, because our access to money for a 5th year is going to be a challenge. Okay, got it. Let's say that we have a junior in college, and now it's 2025, and 2025 is their junior year. So they've gone freshman year of college, they've gone sophomore year of college, and now it's junior year of college. This family has already borrowed $100,000 in parent loans. Okay. They can, because they're an existing borrower, continue to borrow that kind of money. So 2025 is the junior year. 2026 is the senior year of college. But this family has been counting on income-based repayment plans. So what do? Okay. They have 2 options. They can stop the federal loans at the end prior to July 1, 26, consolidate and put all of that in the old income-based repayment, but then they will have no more access to federal loans. Okay, that's one option. Or they continue with the unlimited And when that student is done with school in June of 2027, then they go into standard repayment, probably on a 25-year schedule because the loan balance will be that high. And then they'll make those payments for 30 years. After July of 26, they won't have access to an income-based repayment plan. Okay. Oy. All right. Student number 3, and I think I have 4 altogether. Student number 3 is graduating high school in 2026. They're starting college in 2026, and they didn't borrow. They're not an existing borrower. They are a new borrower, but they need $40,000. Okay. What do we do? We can't go to the Federal Plus loan and get 40. We can go because of now we have the 20 cap. So what are their alternatives? It might be a private loan, it might be home equity, it might be, something else. This is a big question, okay? Maybe they can pay a portion out of pocket from income. Maybe there's some savings. Do we go ahead and use the federal loan now? And then maybe our debt to income is off for a private loan later? Or do we flip that and we use private loans now because we have no debt and we can get better interest rates, and then use the federal loans later? It really depends on the family. It depends on where we're at in school, if we're in a 4-year program or a 5-year program. Depends on if we have other kids coming after. This is the financial planning part of college, and it is as equally important as the admissions part of college. Okay. All right. This is my last one, and this one I didn't even tackle on my own. I referred this to my certified student loan professional who is an expert in repayment. So I know when to tap out. And this was this one. So this family already graduated 2 students from college, and they had 360,000 in ParentPLUS loans. Unlimited borrowing. Go right ahead. Now they have a freshman starting at NYU and they need 78,000 for this student. Okay. What do we do? Mom has since in the middle of a divorce. It's contentious. So of course, dad doesn't want to pay. And mom had signed for these loans banking on the income driven repayment plans. So they have the option, and it's their best option. They're going to take the 78 for this academic year. And because the deadline for income-based repayment is July of 26, before July 1 of 2026, they're going to consolidate all the existing loans and go into repayment for those loans, go into income-based repayment for those loans. And then this student's senior year is going to fall under the cap. So they're going to have to go find some other money from somewhere else, and they're going to have to repay that on the standard repayment plan. Okay. Yeah. So there are quite a bit of families, and we'll probably start to see them in the media, who are caught in the middle like this. But in the repayment problem, if you have a student who's starting their freshman year in 2025, I would suggest just taking a little bit of a parent loan and incurring that interest in order to keep that window open. There's very few scenarios where that's not going to make sense, just to be able to have that grace period. If your student's a 2026 grad, then you're a new borrower, and those are different questions and different projections to make. So here's what this means for all of you on this call, and I'm so thankful that you're on this call because you're thinking ahead. So you have to be strategic with your borrowing. your private borrowing, your parent borrowing. If you have assets to reposition, and lower your student aid index, do that before you file the FAFSA form, before you file taxes. The two are, are related, but not maybe as tied together as you might think. Um, Figure out how these loans are going to get repaid. So, how do we use the loans to pay for college? And then how are we going to repay these so that it's tax efficient and there's no surprises? Okay. Implore upon your students that they have to be done in 4 years. Part of these changes are because on average, it's taking students 6 years to complete their undergrad degree. This is too costly for them to be doing that. So that's one of the other pressures of this bill that they're hoping for. 4 years. Maybe that's summer school. Maybe that's you got to take 21 credits for one semester. Kill yourself for 6 months, and just lock in and get it done. It can be done. It won't be fun, but it can be done. And then plan on the debt. The old safety nets of income-based repayment are going away. PSLF is going away for us parents. So figuring out what that debt's going to look like, how much we can carry, and how that gets paid back is part of your responsibility as a parent. I say our responsibility as a parent while our students are doing what they should be doing as far as their grades and their test scores and their essays and all the things. We have our responsibilities to take care of this on this side so that it comes together how you all need it to and want it to. Okay. So I'll get off my soapbox. I'll turn to the chat for questions, or you can open yourself up. Your next step is, if we're not already working together, then let's talk about your family. Email us at support and say, hey, I want to get together. If we are already working together, we're going to work on this for your family and your kids, so we know by the time they graduate and we're ready to go to college. When you talk to us, I know your time is valuable, and so we'll go over this. We'll calculate your student aid index. I will give you free access for a limited amount of time to our college planning software so that you can plug in your colleges and see where things could end up. If anything, just having a conversation is going to give you clarity and confidence. And like I said, just email Monica at support and we'll get you on the calendar. Okay. So let's go to questions. One of which is, let me make this chat a little bit bigger. When you say asset repositioning, are you talking specifically about taking advantage of re-added exemptions for family business, et cetera, or something more general? So it could be all of the above. When you're filling out financial aid forms and you're reporting parent assets, we have to put our checking, our savings, our taxable brokerage account, and the 529 amount for that student. Some families, that's going to really increase their student aid index. So the conversations will be, what if we reposition these? What if we put these in non-assessable accounts? Non-assessable accounts are going to be tax deferred type of accounts, your IRAs, your annuities, your cash value life insurance. There's parameters there. So we talk about what does it affect? How will it affect the student aid index? How will it affect your tax return? How does it affect your long-term financial plan for retirement? There's a lot of things that you could do, but it may not make sense to do it in relation to your long-term retirement plan. Student assets, same thing. If kids have money in their name, 20% of whatever they have is going to get kicked toward the student aid index. So does that make sense to keep it there? If it's money we know that's going to get spent on college anyway, then maybe it makes more sense. So there's a lot there. As far as income goes, the income that your student aid index is calculated on is your adjusted gross income. So that's line 11 on your tax return. If that's on the higher end and it's pushing up your student aid index, there's a lot in this new bill that maybe you could take advantage of, like commercial solar program, short-term rental and cost segregation analysis, or cost segregation analysis. There's a lot, and I have tax strategists that can look at our tax returns and say, hey, here's a strategy that you could offset X number of dollars from your income and lower your AGI, in turn lower the student aid index, and in turn increase our financial aid eligibility. That's generally what we're talking about. How effective that is and how much financial aid that's going to result in will depend on the colleges that your student's looking at, or on the colleges that your student's already enrolled in. Okay. The tax return information is a 2-year look back. That being said, you file the financial aid forms. Let's say you filed financial aid forms for this academic year, 2025. When you did that, you used your 23 tax returns. Well, that could be very different than what your 24s look like, and it could be very different from what today looks like. So forms are filed with the prior year tax return, but when the current situation looks different, then that's an opportunity to appeal. And the effectiveness of the appeal, again, depends on the college and depends on the college, period. Okay. This is a very long-winded answer to your question. I hope that answered it. If not, ask me something more. Thanks, Nick. And then my student is starting college in a couple weeks. Our current plan for the next 4 years doesn't include parent borrowing. Would you still suggest to take a nominal ParentPLUS loan to keep that grace period open? I would. I mean, 4 years is a long time, and who knows what could happen. I mean, parents get sick, families, lose jobs. So I do feel like it's a little bit of a safety net to take something. You can pay it right back. There's no prepayment penalties, and they'll distribute this portion for the semester. You could pay it off. They distribute the second portion for second semester. You could pay it off, and you can really keep those interest charges at a minimum, but it still keeps that window open for the grace period. So, yeah. Okay. And then, is the formula for calculating SAI for FAFSA changing as it did 2 years ago? No, the formula did not change. That's staying the same. The only change in the calculation is that we were reporting the value of our businesses, and we don't have to do that. That question should go away. Whether or not they program it that quickly, we'll see. But even if we have to answer those questions, it's not going to be used in the actual calculation of the SAI.
So
Yeah.
can I ask a follow-up question?
Yeah, please.
So okay, so I don't own a business, so that part doesn't really affect me. But is it safe to say that I would expect to get the same level of aid that I've got in the last 2 years?
Oh, that's a good question. Yes, as long as your student aid index stays about the same.
Okay.
Mhm.
All right.
Yep,
Great.
if your income's generally the same, your assets generally the same, your SAI is going to be generally the same, and yes, you should expect the same financial aid from the college. If you don't, if all of that is true and you don't get the same financial aid package, I would be on the phone to financial aid and pushing on them. And and here's why. Your student is already a sophomore or a junior or even a senior. And that college needs your student to finish so that they can report those numbers. When students don't finish and they transfer out or they don't graduate, those reflect back poorly on the college. So now you're in a situation where the college should have as much of a vested interest in your student graduating as you do. So yeah,
Yeah.
it should be the same.
I guess I'm asking more about in terms of Pell Grant and
Mhm.
subsidized loans.
Yep,
So it sounds like that's not going to, I shouldn't expect that to change as long as I
correct.
don't have changes on my end.
Correct. Yeah.
Okay,
And the
cool.
student loan does creep up a little bit for them. So their first year it's 5,500. Second year, the maximum is 6,500. Third year, junior year, it's 75, and fourth year it's 75. So you will see that improvement. Okay. Anyone else? More questions? Okay, it's a heavy topic. I had to get it out there. And like I said, if we're already working together, this is going to come into our conversations and into your coaching. And if we aren't and you have questions or want some guidance, then email us at support.com or so I'm sorry, support at mycollegeauthority.com. Monica will get you on the calendar. Okay. Thanks very much. Have a good night, everybody. All right.
Corey,
Yes.
can I ask you one more thing? I didn't want to
Yes.
ask it because you already covered it and I just got
Oh,
interrupted. It didn't hear quite what you said, so I didn't want to make everybody sit through this a second time.
okay.
But on your slide about the Pell Grant,
Yep.
you said the amount stays the same at 7,300.
73.85. Yeah.
Okay. Is it 85?
Something like that.
Okay.
Here, where are we at? Do, do, do.
Way back at the beginning.
Yeah. Do, do. There we
I'm
go.
sorry, I just got interrupted, right?
73.95. Excuse me.
Right as you were saying something really important, I missed it. Okay, so I got that part, and then I got the part about how you have to be taking 15 credits. I didn't get the part in between. Minimum
So
Pell.
the minimum Pell Grant that will get awarded is $500.
Okay,
And so what the college does is they take the 73.95 and they subtract your student aid index. And whatever the difference is, that's how much Pell Grant you get. But if the difference is less than $500, you're going to get zero.
okay. So the best SAI is 0, correct?
Yeah, yes. Yeah.
Okay,
You can have
because
a
then,
negative SAI, but it's essentially a zero.
okay,
Hmm.
okay. So then if you have a 0, then they subtract that and the student gets the 7,395.
Correct.
Okay, okay, and that's not changing.
Not changing. Hmm.
Excellent.
Yeah. Yeah. Good. Okay.
Thank
Anyone
you for going
else?
over that a second time. I
No,
apologize.
happy to. It is very confusing. This is what I do all day. I did a webinar on this for a professional group earlier today. It's important and can be confusing. So happy to do it. Okay. Last call. Anybody? Going once, going twice. All right. I thank you as always. And if you think of something later, you're more than welcome to email us and we'll do what we can to help. Okay. Good night.
You know
Bye-bye.
what? Can I ask one more question? Sorry. Sorry. I think I have this correct, but I want to just make
Okay.
sure. So okay, so if you qualify for the Pell Grant, that's a 4-year maximum undergraduate situation,
No,
correct?
no. So you do the FAFSA every year and you qualify every year. You can get the Pell Grant for 6 semesters. So, um, no, I'm sorry, for 6 years. So 12 semesters.
Okay.
Mm-hmm.
Okay, so I have that wrong then.
Yeah. Now, uh, the student loan is the 4 years, and then if they need a fifth year, they can only get $4,000 on a student loan.
Okay, that's where I get the 4 years from.
Okay. Yeah.
Okay, and then, but then if they were going to go on to get a master's degree, then there's a whole nother category on that, correct? Or no?
So after the first undergraduate degree, all this grant money is unavailable. The Pell Grant, the student loans, the undergraduate student loans, that's only for the undergraduate degree. If they're
Okay,
going, when they go to grad school, law school, med school, then we don't have, as parents, we don't have to be on the FAFSA. It's just them. And at that level, there's no federal grant money. There's loans, but there's no federal grant money. The grant money is going to come from the institution themselves if they have it to give.
okay,
Yeah. And a lot of them do. I was working with a family today and daughter's going to med school, and we have to put parents' information on the med school paperwork because the med school has their own money to give, so they're going to consider parent information. But that's a different thing.
okay. So
Mhm.
that's like the CSS profile that some
Something.
require, some and don't, some
Yeah.
don't. Okay,
Something like that. Yeah.
okay. All right. Thank you for letting me ask another last minute question.
You're welcome. You're welcome. Anytime. Missy, I see you. Hi. Two familiar names. Okay. All right. You're welcome. Take care. Have a good night.